Hello everyone, today with MarketXLS we're going to talk about the short iron butterfly spread option strategy. MarketXLS is one of the top Excel-based investment research solutions for investors. In this video we'll be discussing what a short iron butterfly spread is, how it works, and how it is calculated using MarketXLS. So without any further ado, let's start with the topic. An iron butterfly spread is best implemented when you expect the underlying security to experience neutral price action in the near term. An iron butterfly spread strategy is a limited profit and a limited risk strategy. A short iron butterfly spread is a four-part strategy consisting of a bull put spread and a bear call spread in which the short put and short call have the same strike price. All options have the same expiration date, and the three strike prices are equidistant. What we do in this strategy is that we go short on the ATM put option as well as on the ATM call option, and we go long on the OTM put option as well as on the OTM call option contract of the same underlying security and expiration date. MarketXLS offers a template for this strategy. Here's an introduction page for users to read, and here's an active template. The yellow cells have to be inputted by the user, so the stock ticker, expiry date, ATM strike price for put/call, and OTM strike prices for the put as well as the call. Upcoming expiry dates are available for reference. For the purpose of this video, we'll be using Facebook, expiry date is 19 February. ATM strike price is $270, OTM strike prices for put and call is $250 and $290. We've sold the ATM $270 call and put option contracts and bought one OTM $250 put option as well as one OTM $290 call option contracts of Facebook. We've built the net credit strategy and got $617 to enter into the trade, and this is reflected in the net cash flow section. MarketXLS has many templates just like the short iron butterfly one you see here, and it refreshes all the data when you click on Refresh All. A payoff schedule and a payoff diagram are available in the template too. They can be used to analyze the maximum gain, loss, and break even. The maximum profit potential is equal to the net credit received less commissions, and this profit is realized if the stock price is equal to the strike price of the short options at expiration. In this outcome, all options expire worthless and the net credit is kept as income, and this is highlighted by the green box. The maximum risk is equal to the difference between the lowest and middle strike prices minus the net credit received as highlighted by the red boxes. That is all for today. If you want to read more about this topic, please visit the MarketXLS website, which has hundreds of blogs and templates. If you want to get in contact with us, please book a demo and we'll be happy to help.